All right, Bank of America is staying away from the asset-backed securities market it tapped for nearly $14 billion last year. B of A lacks enough quality loans in its credit card trust to sell TALF bonds without being labeled a subprime issuer. Joseph Mason is a banking professor at Louisiana State University. He is also a senior fellow at the Wharton School, and he joins us now from Baton Rouge to talk more about this. Thank you for joining us, Professor. Let me ask you, first of all, about the Fed's rule on selling TALF bonds without being labeled a subprime issuer. I mean, is this a rule that you think maybe needs to be changed, or is it there for a good reason, keeping Bank of America out?
Well, there's really no good reason for this artificial cutoff. I think we're seeing the unintended consequences of this kind of cutoff. I don't think the Fed ever expected B of A to fall on the other side of this.
What happens if you are, however, ruled a subprime issuer? I mean, what's so bad about that that B of A doesn't want to touch it?
Well, you're not a subprime issuer. Remember, you may be a subprime lender, but that's different than the credit quality of the securities that you issue. If you have subprime loans as collateral in your pool, you probably have far higher credit enhancement underlying those AAA securities that you're securitizing than if you have prime loans. So some of these subprime loan deals can have 40% credit enhancement vis-a-vis the, say, 2% credit enhancement in the prime deals. Which one is safer? I'm not really sure. In fact, the ratings agencies have voted, for better or worse. Both are AAA. Both are really equivalent. There shouldn't be this distinction.
All right, so Professor Mason, help me out here, because we have this story, Bank of America shunning, credit card debt. I mean, how much is B of A maybe suffering because of this inability?
Well, B of A is not the only one suffering. They're suffering quite a bit on the credit card side. Now, B of A is a diversified institution, so this isn't going to cause them to go out of business or anything. Now, on the other hand, you do have monoline credit card lenders out there that also fall afoul of this restriction. They can't issue today, and they're in dire straits.
I wonder, we heard all weekend from Ben Bernanke and Jean-Claude Trichet and a bunch of central bankers about how they need to take advantage of this crisis to increase regulation of banks and try and decrease or at least put a cap on the risks they can take. Is this one way of doing it, or do you think it's a strategy that backfires and maybe we can look into the future and say maybe they shouldn't be in charge of this kind of stuff?
Now, this is a very simplistic way of managing this risk. These kind of artificial distinctions really show how behind the curve the regulators are in this world. Anyone who trades in this world knows it's credit enhancement, not the underlying collateral, that matters.
All right, so what do you think about Bernanke's push and Trichet's push to take on more regulatory power? I mean, you've already got the strike against them that they didn't see the whole crisis coming in the first place, maybe in the case of the Fed, helped to bring it on, and now they're implementing policies that seem to backfire here. Are they winning any points?
No, they're really not. And really it is this distinction between credit enhancement and collateral quality that's crucial to regulation going forward. I would agree that commercial banks should be selling some of the most plain vanilla deals, some of the safer deals, but all that really means is that they hold greater credit enhancement underneath their AAAs or their A's or their AA securities than a non-bank issuer in order to ensure stability and liquidity for bank-issued securities. But this is a point, like I say, it's just indicating how far behind the eight ball the regulators are. They're still trying to learn what this market is 2.5 years after the crisis started.
That worries me to hear that, Professor Mason, that you think they're kind of behind the curve here. I mean, what can they do at this point, maybe potentially to catch up, or can they?
Well, it's an interesting dynamic. The economists within the regulatory structures do realize these elements, as do many of these examiners. The problems seem to be at the top. The leaders don't get it yet and really do need the education to bring them up to speed to advocate sound policy.
Let me ask you quickly, everyone seems to be behind trying to ease credit conditions, but the Fed seems to do a lot of things as far as regulation goes, especially concerning credit cards, that go the other way. I mean, do you think we don't need to ease credit conditions? Do you think they're doing a bad job of something they should be doing? What's your take?
Well, easing credit conditions is just potentially getting more supply out there. You have to wonder whether consumers demand that right now, and in some sense, prudent consumers don't demand credit. But you're right, and this is a much deeper topic for another day. A lot of the credit card regulation we've seen come through the pipe restricts credit further. Even the TALF programs are not for expanding credit, they're only for maintaining credit. Issuers can't go beyond last year's issuance for replacing outstanding securities facilities. So really this isn't about expansion even. All the programs so far have just been about maintaining status quo.
We've got to run. Thank you so much. We're back in 2.